Now, 29 companies have actually applied for a digital banking license, of which 5 will be announced in the first quarter of 2022. Now, in this video, we're going to check out what's the differences between a digital bank and also a traditional bank. Let's check it out. Now, what's the big difference between a traditional bank and a digital bank? Easy. Branches. Digital banks have no branches or aim to have 0 branches. Now, what this means is this: if you look at a traditional bank where you would open an account, now what would you normally have to do? You would have to drive yourself to a branch, take a ticket, wait in line, give them some identification. That whole process will probably take you half a day or 3/4 of the day. Now, what they hope to achieve with the digital bank is this: that as long as you have a mobile phone, you can actually download an app. You can do all that paperless. Now, the second main difference between a digital bank and a traditional bank is this: they are expected to go 100% paperless. Now, so if you think about the processes that you had to go through with a bank, where you had to actually put a wet ink signature on the forms that you had to fill out and the whole process, they hope to be able to achieve that by leveraging on technology to be 100% paperless. Now, the third main difference between a digital bank and also a traditional bank is this: digital banks are meant to change the way they do credit scoring. Now, if we look at a traditional banking process of how you would apply for home loan or maybe even a car loan, they were going to ask you for things like this: your latest pay slip, your EA form, maybe your tax returns, maybe your EPF, and possibly also your bank statement to show where that pay is actually paid into, to prove that you actually have income. Now, this traditional way of credit scoring has not really changed in a long time. Now, which means that a lot of people who don't fall under this category actually will not be included in credit facilities offered by a bank. Now, how digital banks are supposed to be different this time is this: they're supposed to cover the area which is not being covered by traditional banks, which means that if you don't fit in that profile, you're not eligible for a loan today. But what they hope to do is actually improve financial inclusiveness, which means that you may still be credit worthy even though you don't fit into that traditional credit model scoring. Now, you're probably wondering what's the difference between an e-wallet issuer or say a traditional bank with online banking. Why is there a need for a digital bank? Now, if you have experience using an e-wallet before, if you remember, if you top up money into your e-wallet, what happens is that money actually gets funneled back into the traditional banking system, which means e-wallet issuers really earn money a few ways. First is the balance left in your e-wallet, whatever interest that can be earned actually goes to the e-wallet issuers. The second way that e-money issuers actually make money is through charging merchants for using their service, and they make money through number of transactions that are being done or by the value of transaction being done. Now, the second element is this, right? There are so many money lending. If you kind of walk around, you see a lot of posters that says, licensed money lenders. Now, interestingly enough, these licensed money lenders are actually not licensed by Bank Negara. It doesn't fall under their jurisdiction. Now, money lenders today, there are about 4,200 licensed money lenders here in Malaysia. Now, money lending traditionally actually predated independence. And money lending licenses were actually originally issued by councils, right? So you can walk up to your local council and actually apply for a money lending license. Now, today, I'm just going to check to make sure that I don't make a mistake. Money lending, it comes under the Ministry of Housing and Local Government, which is also known as KPKT. So money lending, how it works is this: if you are a licensed money lender, you have the license to legitimately lend money out. But the source of funds has to actually come from your own shareholders, or if as a company you borrowed money, or even raise some bonds as well. So which means that the owners of borrowing that money comes to the shareholders of the company. So whatever capital that they can borrow and then re-lend it out has to come either from the shareholders or from loans that they would have taken out. Now, the big difference between a money lending company and a bank is this, right? A bank can essentially take deposits, which means that if you put money with a bank, they can actually take those deposits and actually re-lend it out to make a profit. So now you know why the big difference, why a lot of people are actually looking at, or there are a lot of applicants looking at digital banking, is because of the ability for them to take deposits rather cheaply, actually, and actually re-lend it out, which means that they're using other people's money to lend it out to then make a profit. So now you have it. I hope you guys enjoyed this video. Don't forget to like, subscribe, or share, and click the notification button so that you'll be notified on the next video. Thanks for watching.